The hot seat this evening is Linda Eedes, Portfolio Manager at ReCM. My co-host Wayne McCurry is still with me on the desk. Linda, thanks for joining us today. We're taking a look at your global fund in today's session, and worth around $253 million and incepted in March 2006.
Right.
With all this volatility that has come to the fore, how has performance been? Because I know since inception you 5.8% return, benchmark has done 2.3%, and the benchmark of course is the MSCI World plus 2.5%.
Well, it's actually done very well, and part of that is it's a fully flexible global equity fund, so we have total flexibility to hold as much cash as we need to if we don't find sufficient investment opportunities in the market. And we actually think that volatility is a good thing. When volatility is low, you know, everybody tends to be doing the same thing, and volatility introduces uncertainty, but that's when the opportunities arise. So we're actually seeing more value today than we were 6 months ago.
Now, Linda, when you look at the fund, it has done well. Would you ascribe that to the right asset allocation, in other words, cash or shares, or to actual share selection? Obviously, it's a combination, but is there a dominant factor in that?
Well, actually, we've done the numbers, and there isn't a dominant factor. It's about 50-50.
Okay.
And the reason for that is that flexibility is very important, you know, because we've used it correctly. But also our emphasis on the global side is on high-quality companies. And so there, what we're trying to buy is high-quality companies which are crucially undervalued when we buy them. And that also helps to protect against downside risk. And this fund has done particularly well when there's been market declines.
And how have you found the demand in South Africa for global funds? Because they've unfortunately, no one's really made money in rand terms over a long time period.
Yes.
Have you found there's been some demand?
There has been some demand, but you know, investors do suffer from chasing performance. So you know, the South African equity markets have performed well over the last 10 years, so they're hesitant to invest elsewhere. But they're about to make precisely the same mistake that they made going offshore 10 years ago, which is that 10 years ago global markets were expensive and South African equities were cheap. Today it's the reverse. And so we're recommending that clients who do have the ability to take money offshore, now is a fantastic opportunity to do it relative to valuations in South Africa.
Well, let's look at asset allocation. In July 2011, so a month ago, you were sitting with cash of around 25% in the portfolio. In July 2010, you had a bigger cash position, which was around 30%. Some would argue that cash is the best place to be right now, given all the volatility and the fear. How are you mitigating risk when it comes to allocating cash versus equity?
Well, we would agree that cash is a very effective hedge. So, for instance, if you cannot find undervalued equities, then rather be in cash. Don't try and play the relative valuation game. Having said that, we are finding pockets of value globally where we are able to buy businesses at 30% or more less than what they're worth. So that's why the equity allocation has actually increased, despite the fact that the market as a whole still remains overvalued.
Your top holdings, Johnson & Johnson, the likes of Dell as well, having quite a strong presence. And then you also, Walmart is within that space. Let's talk about those three stocks, because they're fascinating. They're all basically linked in a sense, because they are US multinational companies which have their tentacles within the emerging market space. Is that the strategy when you look at those specific companies?
Well, looking at those companies, it's actually a great example of the difference between a quality company or good company and a good investment. Johnson & Johnson, Walmart, companies like Intel, Dell as well, you know, if you looked at them in 2002 and I said to you that over the next, 10 years, these companies, their earnings are going to just about double. Their operating profit is going to just about double. Their earnings per share are going to more than double. You would think, well, this is a fantastic investment opportunity. And yet the share prices of all of those examples that you've listed have done virtually nothing over that period of time. And the reason for that is not that the companies have not done well. They've actually done very well. The reason for that is that they were overvalued in 2002. Yeah. Johnson & Johnson was trading in excess of a 30 PE. Today it's trading at a 13 PE. Dell also, was part of the hype of the tech boom. Today it's also trading at very low multiples relative to the market. And so a good quality company is only a good investment if you buy it when it's cheap, which is what we look to do.
Do you agree with that, Wayne?
Yeah, look, if you ignore the economy for the moment, if you had to just look at valuations, these are cheap companies there. If you had to just look at valuations and nothing else, US shares are cheaper than SA shares. But now there's different growth projections for SA versus the US, and we can argue that for a long time. But under any normalized situation, and of course you make maybe it's an heroic assumption that the economies will normalize back to some level at some stage, shares are actually cheap. I mean, the dividend yield on the S&P 500 is higher than the dividend yield in South Africa. Now, that's only happened once before in 50 years. And that was a while back in the peak of the 1980s gold boom in South Africa, the early 80s gold boom, and we underperformed for the next 30 years. Now, I'm not saying it's going to happen, but as we spoke about earlier on, when there's uncertainty around hang your hat on valuations, US shares are not expensive.
Well, this is the argument, and I think Linda touched on it when she said, 10 years ago we saw that South African shares were looking cheap and US shares expensive, and now we're seeing the reverse. Do you buy into that story, or do you think that there's a lot of risk?
Look, I mean, obviously in investments there's a whole lot of, you've got to take into account current valuations versus future growth prospects. But what I know for sure is that our market today is 5 times more expensive relative to the US than what it was 10 years ago. So I know that, because that's just a fact. I mean, and if you look at the performance of our market in dollars, as I said earlier, the performance of our market in dollars is exactly where it was relative to the US in 1981. So it's reversed 30 years of underperformance in 10. And you've got to ask yourself, what's the ability for this just to carry on? It doesn't mean our market can outperform, but does it just carry on? I don't think so.
Okay, so Linda, when you see stimulus worries, we could see more stimulus from the Fed, double-dip recession scenarios, top-down versus bottom-up approaches, or are you just purely looking at valuations here? I'm sure you take into consideration what is happening on a macro level.
Well, what we take into consideration are the fundamentals of each business in itself, and I think there's going to be a lot of differentiation. That's where you really need to focus on companies which have strong balance sheet, strong cash flow generation, those that are likely to actually weather any tough economic environment. Economic growth has actually been a little bit of a misnomer in terms of leading to investment returns. And the reason for that is that the market tends to be overly optimistic where higher growth is expected and overly pessimistic where growth is not expected.
Very quickly, going forward, tell us what your play is going to be with regards to reweighting portfolios.
Well, we continue to do exactly the same thing as we've done over the 5 years of this portfolio, this fund, which is to invest in high quality, undervalued shares.
Fantastic.
And defer to cash when those don't exist.
Fantastic, Linda. Thanks so much for joining us in studio today. Great to have you in the studio. That was Linda Eedes from RCM.